Are the habits you trust the most keeping you financially stuck? The truth is, most people aren't held back by their income. They're held back by the way they manage it. Whether it's relying too much on debt, spending impulsively, or ignoring key opportunities, these habits can quietly drain your potential for wealth. Today, we'll break down 14 critical money habits keeping you poor and show you how to fix them. By the end of this video, you'll have the tools to escape the paycheck-to-paycheck cycle for good. Let's begin with a concept made famous by Robert Kiyosaki in Rich Dad, Poor Dad. Pay yourself first. This strategy flips the traditional approach to money management by putting your savings and investments ahead of bills, entertainment, or discretionary spending. Here's why this is important. A report from CNBC in 2023 revealed that the U.S. savings rate had dropped to 4.1%, one of the lowest in decades. This means that people are prioritizing spending over securing their future. How to pay yourself. First, automate transfers into a high-yield savings account or investment portfolio. Start with 20% of your income, adjusting as needed. David Bach, author of The Automatic Millionaire, explains, "Paying yourself first is the single greatest habit for building wealth." Please like and subscribe. Leave your thoughts in the comments. Your support is appreciated. Thank you. When you pay yourself last, you're letting external expenses dictate your financial future. According to Bankrate's 2022 survey, 58% of Americans have less than $1,000 in savings, with most citing not enough left after bills as the main reason. Here's the problem. When you pay everyone else first, landlords, credit card companies, utilities, there's rarely anything left for you. Wealthy individuals avoid this by treating savings as non-negotiable, not optional. Suze Orman says, "If you don't put yourself first, no one else will." Once you've flipped this habit, let's look at another major financial trap, using debt for everyday purchases. The Federal Reserve reports that U.S. credit card debt surpassed $1 trillion in 2023, with a significant portion going toward everyday expenses like groceries, gas, and entertainment. Why is this a problem? The average credit card APR is now 20.68%. If you carry a balance of $3,000 and only pay the minimum, you'll owe over $1,000 in interest within just 2 years. How to avoid this trap? Use cash or debit for everyday purchases. Create a zero-based budget, ensuring every dollar is accounted for. Ramit Sethi, author of I Will Teach You to Be Rich, warns, using credit for everyday expenses creates an invisible drain on your finances. But credit card companies don't just profit from your purchases, they count on your mistakes. Let's break down their strategy. Credit card companies are experts in behavioral psychology. Their profits come not from responsible users, but from those who carry balances, pay late fees, and spend impulsively. In 2023, credit card companies made $120 billion from interest payments, according to Wallet Hub. Late fees alone contributed another $12 billion. Tactics they use include rewards programs that encourage overspending and minimum payments that keep you in a perpetual debt cycle. Behavioral economist David Laibson states, "Credit cards are designed to exploit our natural tendency to favor immediate gratification over long-term planning." Let's shift gears to budgeting. What's the cost of not tracking your money? If you don't track your money, you'll never know where it's going or how to redirect it toward your goals. A 2022 Gallup poll found that 68% of Americans don't budget, often citing a lack of time or understanding. Steps to start tracking include using apps like Mint or YNAB, which stands for You Need a Budget, to log every expense. Review spending categories weekly to spot trends and cut back on waste. Suze Orman advises, tracking your money is the first step to taking control of it. But even with a budget, there's another hidden threat: lifestyle inflation. Lifestyle inflation occurs when your spending increases along with your income. For example, a raise becomes a reason to upgrade your car or move to a pricier apartment. The Bureau of Labor Statistics reported that household spending grew by 9.1% between 2021 and 2023, outpacing wage growth. This leaves many people no better off financially, despite earning more. Set a cap on lifestyle upgrades. For example, limit discretionary spending to 10% of any raise. Speaking of spending, let's look at hobbies. Are they holding you back? Expensive hobbies like golf, collecting, or high-end tech may be enjoyable, but they can undermine long-term financial goals. A 2023 survey by NerdWallet revealed that the average American spends $1,200 annually on non-essential activities. Identify hobbies that align with your financial goals. Set a monthly limit for discretionary spending. But even saving alone isn't enough. Let's discuss why investing is critical for wealth creation. Saving builds a foundation, but inflation erodes the value of idle money. In 2023, inflation averaged 6.5%, while savings accounts offered interest rates below 1.5%. Invest in assets like ETFs or mutual funds that historically return 8 to 10% annually. Warren Buffett famously said, "If you aren't investing, you're losing money every day." Taxes are another silent wealth killer. Let's explore how to minimize them. Taxes are often your largest lifetime expense, yet most people don't take advantage of deductions or credits. According to the IRS, Americans left over $1 billion in deductions unclaimed in 2022. Tax-saving strategies. Max out contributions to tax-advantaged accounts like 401ks, Roth IRAs, and HSAs. Use a CPA to identify deductions specific to your career or side hustles. But waiting to invest is one of the costliest mistakes. Let's explore why. Time is your most valuable resource in wealth building. Starting at age 25 with $10,000 invested at an 8% annual return will grow to $217,000 by age 65. Waiting until age 35 reduces that total to $100,000. Start small if necessary. $50 a month is better than nothing. Once you invest, inflation becomes a key challenge. Let's address it next. Inflation reduces your money's purchasing power. At a 6.5% inflation rate, $1,000 today will only buy goods worth $735 in 10 years. Invest idle cash in inflation-beating assets like real estate, stocks, or high-yield bonds. Not sure how to start? Let's address the barriers to investing. Fear, lack of knowledge, and analysis paralysis are common hurdles. According to Charles Schwab, 59% of non-investors believe they lack the expertise to begin. Use beginner-friendly platforms like Robinhood or Fidelity. Start with index funds to minimize risk. Finally, let's talk about protecting your investments through diversification. Diversification is your best defense against market volatility. The 2023 banking crisis highlighted the risks of overconcentration in one sector. How to diversify. Spread investments across stocks, bonds, and real estate. Include international assets for additional protection. Ray Dalio says, "Diversification is the only free lunch in investing." The wealthiest individuals balance two levers: aggressive saving and scaling income. Forbes reports that self-made millionaires have an average of 7 income streams, including real estate, dividends, and business ventures. Focus on saving aggressively while building passive income streams. Now that you know the habits holding you back, it's time to take action. Thank you for watching this video. Please like and subscribe. You can check out another video that is now on your screen.